Hi, folks. Good morning and welcome to the live stream. I hope you guys can hear me. If anybody can give me a shout, if you are not able to hear, would appreciate it. If you are not able to see my screen or not able to hear me, just let me know and I'll figure that out for you. I think I'm live on like 3 different platforms. I have a webinar registration going. I have the YouTube as well as the Facebook. So welcome wherever you are joining on. We got quick 30 minutes. We're going to talk about the Fed rate cuts that just recently happened on last Wednesday. And all the impacts that it could have on your portfolios or the wallet, etc. So without further ado, let's dive right in. My name is Pranav Shingala, and I am a registered investment advisor in the state of Texas. And I try to do this once in a while, where educate, community, clients, whoever would love to kind of understand about uh, what's happening in the financial world, investment world, and anything that I can simplify. I take the opportunity to kind of explain that to everybody. All right, so let's jump right in. Let's look at the agenda real quick. We're going to have. We'll go through the disclaimer and then we'll jump into the who is Fed, what's their role, what's the Fed funds rate, and how does the Fed funds rate work, and also impact of the Fed funds rate on on your wallet and investment portfolio, etc. We'll also look at current market factors, what's going on currently, and then where it's headed. And then finally, we'll kind of pack it up in a summary, and hopefully we can get all of this covered in 30 minutes. So let's jump right in. Once again, welcome if you guys are joining on any of the platforms, YouTube, Facebook, or the webinar. Thanks for spending this 30 minutes with us. Disclaimer, first thing that, look, like I mentioned earlier, I'm a registered investment advisor. So I'm obligated to kind of mention that, hey, I'm not soliciting any business. I'm not soliciting any sale, or I'm not selling any product here. This live stream, this presentation is purely meant for education purposes only. So we are only, and maybe some little bit of entertainment here and there, because this topic about Fed rate cut is a little dry topic. So we'll try and make it fun as much as possible. All right. So the disclaimer is that, if there is anything that you pick up during this presentation that, oh, that looks like a great idea, I should invest just like how it is presented here, before jumping into any of those investments, consider discussing with your investment advisor. If you don't have one, feel free to consult with us later on. But currently, what we are discussing as part of this live stream, it's not an investment advice, or it's not a tax advice, or so do not really directly jump in and go and action upon it. All right, jumping straight into it. So let's talk about who is the Fed, and then what's their role. So the Fed is the Federal Reserve System. I mean, the FRS overall, but they are called as the Fed. So what's their role and what do they do? They are the central bank of the US. So what they are trying to do is, they are the bank of the banks. And if you look at it, they try and regulate the entire monetary and financial system. So making sure the banks are liquidated enough. If there's a bank run, and if you bank with JP Morgan Chase, and you think that they are in an issue, or they might run in an issue, the Fed makes sure that they are capitalized, adequately, so that in case of a bank run, your bank has enough capital to kind of serve all the clients. They supervise the entire banking system. That just kind of alluded to, and not only the bank, the entire financial system. So it includes all the regional banks as well. How it is governed, I mean, who are the people on the committee and stuff like that? So there are about 7 people, the Central Board of Governors. Yep, the man of the hour, who is the Mr. Jerome Powell. He's the chief of the board of governors, and then there are six other. All of the seven folks are nominated by the president, and then the Senate, and the voting happens, and all of these seven guys, they they run. In addition to that, there are 12 regional Federal Reserve banks across the United States. So from Boston or New York all the way to San Francisco, there are about 12 regional banks representatives who also kind of take part into all of these Fed meetings that happen. So I'm sure you have heard into every time there's a Fed meeting that happens, it kind of makes headlines. So I'm sure you guys have heard about this. So these are the 19 folks, 12 from the regional banks and 7 from the Fed governing board. They all get together and look at the data. And you may also have heard about something called a dot plot. And if you look at dot plot closely, there are 19 dots on each of the plot. And these are the 19 guys, which is 12 regional Fed banks and the 7 governors. All right, let's keep moving. What's their role? What do they do? Their goal is to keep the entire U.S. economy healthy. How do they do it? You may also have heard a lot of times Mr. Powell say that they have a dual mandate, and they try to balance this scale. It's a very intricate way to do this by maximizing the employment, so not letting the unemployment go too high, and also the stabilizing the inflation, which is trying to control the prices. So how do they do this? And so we'll get to that in a little bit, and that's the Fed rate cut all about. So the overall, this is the Fed and the role that they try to kind of maximize the employment. The dual mandate is to try to maximize the employment as well as stabilizing the inflation. What's the Fed funds rate? The Fed funds rate, it's the target interest rate range that's set by the FOMC. FOMC, again, we try to not, I don't want to throw in too many jargons, but it's the Open Market Committee, which is again the 19 folks. They set this target interest rate, and that interest rate, it's all the commercial banks, they borrow and lend against each other on the reserves. Now, this might again sound, don't really bog down. I mean, I'm going to simplify this even more in a little bit. So how that works, right, is if you have the central bank, which is the Fed in middle, they have created a reserve requirement for each of the commercial bank out there. So they need to kind of have that much capital in reserves with the Fed. Now, if you have extra money sitting with you, then you can lend it to the other bank, because all the commercial banks, they are in the business of lending and borrowing. So they want to kind of keep on lending the money. And if they need extra money, they are going to go to the central bank and request that, hey, JP Morgan has extra money. I'm a smaller bank. Can I get a couple of $1 billion? And central bank and JP Morgan will be like, sure, why not? And JP Morgan lends that money to the other bank. So this target rate is the rate that federal government decides that, hey, you guys will have to lend each other at this rate. And this rate, Fed funds rate, is purely within the banks, inside of the banks. You or I, as an individual, we don't get to kind of directly face this rate. We face the downstream impact of these rates. So we'll see how it gets into impact, right? How does the Fed funds rate work, right? So Mr. Powell, right? I mean, he has to kind of use all of his tools in his on his tool belt to kind of see. So how do they look at the rate? If they want to they try to lower the rate. So when they lower the rate, what they're trying to do is they are trying to stimulate the economic growth. They're trying to prevent an unemployment rising, or to encourage the spending and investing. How that happens? It's simple. If money is available cheap from the bank for the businesses or for the individuals, people are going to spend more. If your credit card company or your mortgage interest rate is not as high, or if for the commercial purposes of the businesses, if business has a cheaper loan, then they are going to spend more money, the prices are going to drop, and hence the economy gets stimulated by that. So lower interest rate environment stimulates in multiple, and we'll see. The whole topic is about what happens when the rate cuts happen. So that's and then on the flip side, when they start raising the interest rate, that's to cool down an overheating economy. So if you go back, and we'll also show in following charts. I mean, we are a data junkie. We are nerdy in terms of like we look at lots of charts. So we'll share some of them, and then if you need more, just ping me, drop your request in the chat wherever you're joining, and I'll make sure to send that information over to you. On the raising the interest rates, when they're raising the interest rate on the flip side, that's to cool down an overheating economy, or to combat inflation. So if inflation is kind of, it's not going as high, the prices are too low, and just too much going on, overheated economy, then, and also to encourage saving in terms of the if you have higher interest rates, what you're trying to do is what you're going to do is you're going to keep more money into your high yield savings account and stuff like that, because it makes more sense to keep the money in the raising interest rate environment rather than spend it. Uh, the other one is, of course, hold it steady, which is what happened for last 4 years. Ever since after the pandemic, Fed kept the rate steady because the economy was working fine. But as inflation came into picture, as the price started going up, the interest rates started going up. But most of the time the rate remains steady as is, as long as there is a stability in the economy. There is no unemployment, or the inflation data is not unfavorable. All right, so let's keep going on how that Fed funds rate work. We are going to continue a little bit more, and I'm going to share some charts now. So this is the history of the Fed funds rate. It has gone as high as 20% back in the 80s, as you can see here. And recent environment, it was in the range of 5.5, 5.2. So that's the rate. And if you look at this rate, it wasn't there until the rate environment like this was just before 2007 2008 crisis. So we were in a pretty high interest rate environment for quite some time now, for at least a couple of years now, at least since 2022. And the other point I want to mention here is, again, I mean, not to kind of talk about fears or recessions here, but if you notice, there are gray shaded areas on this chart. Each gray shaded area means that there was a recession around that period of time. And if you notice closely, that recession has followed every time after a rate cut has started. So, a rate cut is a little bit of a leading indicator into, what could happen to the economy. So again, I mean, it's not necessary that the recession will definitely happen. No, it's not 100%, but there, more often than not, it has led into recession. Though, I mean, we are looking into kind of a lot of the scenarios where a soft landing could be the scenario where we are most of the economists and the experts are thinking that this could be a soft landing scenario. What I mean by soft landing, or what they mean by soft landing, is that we may not have a recessionary fears. What it also means is that the employment or the unemployment number, which were rising, which it will not continue to rise. It will cool down slowly with the rate cuts that are coming into play now. This is just the kind of how it's exactly the same chart, but in a cartoon way, where each Fed governor, when they came in and they looked at it, just to make it fun. All right, so let's now we are getting into the impact. So this is the crux of the matter. We'll spend about next 10 minutes or so into this. and then if we have time, we'll take some questions. So wherever you're joining, I should be able to kind of bring your questions up. So whether YouTube or Facebook, just put your question in the comment, and I'll be able to bring it on live. And if there is time, then we'll take more questions. Otherwise, later. All right. So let's jump again. Impact of the Fed rate cuts on the stock market. So what happens to the broader stock market? So this is the overall. We looked at some of the numbers, and every time there was a rate cut, we went back all the way to 1973. So 70s, 80s, 1990s, and as latest as 2007, and then 2019, just when the COVID hit, 2020. Uh, if you look at these numbers, how the S&P 500 performed after each after the first rate cut. 3 months after the rate cut, if you look at it again, half the time it was positive. So, 46, 47, I looked at some of the numbers, 46, 47% of the time, within 3 months, market was kind of trending up. In 6 months' time, almost about 60% of the time, market was up, S&P 500. So if you look at majority of these are up, and the last row is the average of all of these cells on the 6 months. So about 4.4% was the average market up after 6 months after the first rate cut. We're not even talking about all the other following rate cuts, which are already on the dot plots. Um, and then after 1 year, so within about 1 year time, the market kind of settles down, takes all of this positively, and majority of this, almost about 80% of the market will be positive in all of this. So chances are that, again, I mean, we don't have a crystal ball. We are purely gauging by the historical numbers. We are purely going by the current environment in the market. So the trend suggests that after the first Fed rate cut, the market will do really well. Now, really well or super, how well they do it depends, and which sectors and which areas of the market will do better. We are going to look into that further. So hang on with me, and you're gonna see more of these numbers here. All right, so this was on the S&P 500 market, which is, like I said, 3 months, 6 months, and 1 year after the first Fed rate cut, the market has majority of the times turned positive. What happens to the sectors? Let's look at each individual sectors in the market. This is what happens in the individual sectors. Majority of the sectors, or at least some of these sectors which are positive. This is alpha. So these sectors are beating the market by this much percentages historically, and this data is also again going back to about 70s. So consumer non-cyclicals, consumer cyclicals, technology, and healthcare. These four are the candidates who generally benefit tremendously out of the rate cut environment, so the lower rate environment, because the prices are going down. So your Walmart or Kroger is going to have more traffic, and then more traffic means more earnings. More earnings is more profit. So eventually, I mean, rate cuts trickles down to consumer non-cyclicals and consumer cyclicals in a much better way. Technology generally, because more of the startups, all of the technology, they rely heavily on the borrowed money. And every time they are relying on the borrowed money, the cheaper money is better. They are able to kind of push out more products, make more earnings, make more profit. Healthcare, the same way. If anybody is kind of putting aside any of the health expenditure for some time, they would, now that they are able to spend, the healthcare kind of picks up a little bit as well. Um, and there will be some more sectors, and also at the kind of higher level, you'll be able to see, which we'll discuss in a little bit, that how some of the other areas of the market gets impacted with this rate cut. So let's jump. I mean, again, all of these sectors, information, all of this is based off of the historical data. So, we don't have a crystal ball that in 2024 as well, the market will do exactly the same thing. Uh, you know, we know that something like utilities this year has done really well. Communication this year so far has done extremely well. uh, but will they continue to do that well? We don't know. I mean, we don't have a crystal ball to gauge, but this, we are purely kind of going by the historical data that we have at hand. Let's jump into the next section, which is again impact of this Fed rate cut on the housing market. People who have not who have decided to kind of or put aside the decision to buy the house. This is a good time now, before market heats up. If you look at these numbers all the way back to 1980s, to even last recession that we had, which was in the 2020, every time there was a Fed cut, the housing market heats up tremendously. The only exception in this case is 2007 and 8 crisis, because that was a housing market crisis. So, but majority of the time, I mean 95% of the time, if you can see, every single year after the Fed has cut the rate, the housing market has shot up at least 6 to 7%. So, and when you're looking at houses in the range of, I mean, the median house prices have gone up to like 400K, 500K now. So 6% jump on that is pretty significant jump. So 6 to 7%, right? So the housing market has cooled down a lot in last at least year or so, especially 2023 and 2024 spring housing market. I had the Bloomberg data again. I mean, you know, I'm a data junkie. I have crazy amount of data. If you really like it, send me a note and I'll share all of this data with you, even including this presentation with you. So what I was saying is that, yeah, 2023 and 2024 spring housing sale have actually dropped. So now that the Fed has cut the rate, and you people who are looking at the mortgage interest rates have already gone down in last three months or so, or almost about 4 months now. So they will continue to go down as the Fed rate continues to go down, and that's going to continue to heat the housing market. So a lot of downstream impact because of the Fed rate cut on the housing market. Let's look at some of the broader indexes, that where they are at currently, and then what we see from our perspective or from our research is what I'll share here. Uh, so this is the yellow line is Nasdaq. This is YTD number, so year-to-date performance of four major indexes, right? We're just gonna and all the data that I'm talking about is as latest as Friday. So I've compiled all of this just yesterday, in fact last night. So all this data that you're looking at is just as fresh as Friday, end of the day. The the Nasdaq did about 19.56% as of YTD this year. S&P 500 is at 19.55. Dow Jones is at about 11.6, and Russell 2000 is at 9.91 YTD. Now, why I'm discussing this market factor right now? Because you will see this in the following slides, that a lot of the candidates that benefit from the rate cut environment are the small caps, and small caps are the Russell 2000. If you look at, they have underperformed dramatically this year. They are only at 9.91, whereas the tech sector, all the AI and Nasdaq and S&P, which has been heavyweight on the technology companies, they have done extremely well so far. Will they continue? We don't know. But what we predict or what we think is small caps, which is Russell 2000, would be a great candidate to kind of go into next, where they will benefit tremendously out of this. So that's on that. Again, I mean, there are a lot of caveats to that. So we have about 5 minutes left. So I'm going to speed up for next few slides. Um, this slide is going to be interesting. Let's look at this. A very interesting data. Like I said, we are data junkie, nerdy. So what is this number that we are looking at? This is the assets, the money that is sitting on the sideline in the money market funds. So, and how much money is this? So keep in mind that this is $6.3 trillion. Currently, about in just in US economy. And this data, again, if you look at it, it's as of Friday for last 20 weeks, right? So as of Friday, $6.3 trillion is purely sitting in money market. It's not even in the equity market. All of this money is purely sitting on the sidelines, right? So now if you notice that, in last 1 week, there is a little bit of a drop that has come in from 6.32 to 6.3. So about $250 billion came into the market. But the point I'm trying to make is that there's $6.3 trillion sitting on the sideline, which is ready to come in now with this rate cut into the equity market, especially in the election environment. So this is a very important number to kind of keep in mind. Again, I mean, if this number doesn't make sense, just shoot me a message and I'll be more than happy to kind of guide it. I want to kind of throw in this one headline, which is, this is from April 2020. This is when COVID hit, the all the money that kind of in the government that thrusted into the economy, that was about 6 trillion. So this money, that 6.3 trillion that we are looking at, that money is as is for the last 3 to 4 years. It's just constantly growing into the money market funds. Important number to keep in mind. Now let's look at quickly that, where this money is sitting. So this is the the sunburst or a CD looking chart where the money is sitting. So it's in about three different sections: in the government, prime market, and the tax exempt market. What's a government market? About 5.13 trillion is sitting in the U.S. Treasuries, repos, all the munis like Fannie Mae, Freddie Mac, and not the munis though. U.S. Treasury, repo, Fannie Mac, agency stuff. That's where the 5.13. So this is the money that's not going to make good money in the rate cut environment. So this money would come immediately, or not immediately, but gradually come into the market. The next one is the prime market, which is about $1 trillion, which is about CDs and commercial papers and bankers' acceptances. So, and then the third one is the tax exempt bucket, which is a tiny bucket, $128 billion. That's a tax exempt, which is the munis and the state bonds. So this entire thing is about 6.3 trillion, which has been on the sidelines for at least 4 years now. Important number to kind of watch. So, let's summarize this. We are right on time, about 2 minutes left. I want to kind of summarize the whole thing. So, rate cut should be, I mentioned this earlier, that, it should benefit the small caps, the floating rate, because most of the smaller businesses have a floating rates. So as the banks are going to offer them cheaper rates, they are going to kind of take that tailwind, reprice or refinance their loans and thrust a lot of kind of earnings. It'll take time, so keep an eye out there. It's not kind of, guaranteed that small caps will immediately do well, but 6 to 12 months from now, definitely they should do well. That's what the past data suggests. The unemployment may continue to rise for a while, because it's a lagging indicator. I mean, what we are looking at right now is that it's cooling, but it may continue to rise a little bit. More often than not, the stock prices, the US dollar and the 10-year bonds, it will rise. So we looked at some of the numbers already. So the stock prices, the US dollar and even 10-year treasuries. So keep that in mind. We looked at these sectors already, the consumer cyclicals, consumer non-cyclicals, healthcare, technology could be the beneficiaries for the Fed rate cut. Brace yourself for a bumpy ride on the presidential election. This is a good note here that, remember that, when there's an election year, trying to diversify your portfolio is the best thing to do, because the times becomes very uncertain. It's unpredictable. The volatility increases, especially in the economics election periods. Now, the Fed rate cut environment, in the lower interest rate environment, the cash may not be the king anymore. So if you are leaving your money into the high yield savings bank account, probably not a good idea to continue to keep it there. One point here is your bank is not obligated to tell you if they are reducing the interest that they are paying you. So they may have promised you some rate in the past that we're going to pay you 5.5% interest on a high yield savings account, but it's not. If they lower it to 4.5, they're not obligated to tell you that, because so keep in mind, cash is not the king anymore. If you want to allocate it, if you just keep the emergency funds, my advice is, kind of look at a lot of different components. Talk to us if you need specific advice. We have to look at your specifics, and then we can advise you where to kind of put the money in. The REITs, real estate investment trust, may become more attractive because they would have higher dividend yields, or the yields on the REITs will increase, or at least even their current yields would become much more attractive than the interest rates, what you're getting on your savings accounts. The the last point is important for the folks who are nearing the retirement. Relying on the fixed income instruments, the strategies like the bond ladder, or the adjusting your portfolio to include the dividend paying stocks, that would mitigate the impact of these rate cuts, because most of the folks who are nearing the retirement, they try to kind of safeguard their nest egg with short-term treasuries and stuff like that. So now it's good time to kind of get into the laddered bonds, or high dividend paying strategies. So there are plenty out there. Again, I mean, talk to us. So that brings me. I mean, I'm about 2 minutes over. That brings me to the end of the session. So join us. This is the if you have more questions, on this whole thing, or anything. I mean, finance. I'm more than happy to share the knowledge, share some information, and like I said, we data nerdy, lots of charts, lots of. If you're not part of our WhatsApp community, I would recommend join us, because a lot of data gets shared there on a pretty much on a daily basis. So I would recommend join our WhatsApp community. And my phone number is on the screen. Give me a call or email me, and I'd be more than happy to address any of the questions. And with that, I think that's it for now. We will see you in our next stream. Thank you all for joining. Really appreciate your time. And I'm assuming this stream will remain on YouTube and Facebook for the future use. So do share it. Help your friends.